alone in 1932, believe it or not, Australia did take the dollar off the gold standard, but that probably wasn't one of the major things. Like, it did bump the market a little bit, but at that time we actually had a thing called price controls on the market. So that was taken off pretty much after World War II, and you can see the boom pretty much after World War II that happened then. So things did change really in that time. You can see before that they were pretty stagnant, but price controls were removed on prices then. And especially since 1970, because the global dollar, which was the US dollar, in 71, Nixon took it off the gold standard. I'm not blaming Nixon for everything, but that set the standard of money printing pretty much to the bleachers for Australia, which is crazy. So, I mean, that's kind of what went on then. You can see kind of since 1970 there just what's going on. It's just continued to go up substantially in value quite consistently. And that number today is closer to the $1 million mark for houses in Australia. So that's kind of what's happening. It's not really based on anything. So that's set to continue because of that. And not only that too, I should just mention markets do run in cycles. So really, it's not every market that goes up in a linear fashion. If you want to extrapolate it over 30 years, yes, it'll look linear on a line of best fit, kind of. But if you look at it on a sort of monthly and annually figure, it'll look similar to this. So you can see Brisbane and Melbourne contrasted to each other there. So Melbourne kind of did have a bit of a flat zone, I'd say, between probably the 2008, I'd say, or 2007, maybe even to 2012. It didn't really do that much. Brisbane went up significantly. Then Melbourne did very well from about 2014 right up to about 2017. Brisbane did next to nothing, only a little bit. But Brisbane in the COVID period went crazy, whereas Melbourne went quite flat. And Brisbane's still going up today. It's probably on top, maybe a centimetre on top of the S on houses for 2025, whereas Melbourne has gone flat to about the S in houses. So don't get me wrong, it's bumped 5 to 10% now in the last couple of months. But that's what I mean by markets running in cycles. They do not go in a linear fashion at all. That's just what they do. That's how markets run. Now, what we've got as well here is I've made a previous episode. For people who haven't seen this, I went into detail about the 18.6-year land cycle in play, and I was showing you where I expect to do well in basically, you can see to the left here, in certain periods. So obviously, just before the major recovery phase, bigger cities generally do better. And funny enough, they've been the worst performers as of recently. So that's kind of where we're at in the market at the moment. Your mid-cycle dip, generally, your smaller cities do a little bit better. So Brisbane, Perth, Adelaide, Brisbane surrounds I've got there. I think they're close to their peak, probably in 2027 to 2028. And in 2028 to 2030 is when you're going to get a major boom, especially for Melbourne, Geelong, Sydney, Newcastle, Central Coast, Wollongong. The Sydney, particularly Melbourne and Geelong especially, and then secondly after that, Sydney Basin region. And that correlates pretty accurately with where you kind of look at on the right-hand side. So you can see the green is where you probably want to buy the major cities. The kind of the lighter grey you can see there, which is kind of in 2021, really 2018 to 2020, which is the orange. That's when you wanted to buy the smaller cities. So that's how the 18.6-year land cycle comes into play when you're looking at property prices. It is behavioural. There are better times to buy certain markets and worse times to buy them. But it's very important to do so at the right time, because these areas are extremely important to get right, because you're going to exponentially increase the return you're going to get on these assets. So it's very important to get this right. Not everyone does, but markets do behave in cycles. So that's just something to consider. That's the 18.6-year land cycle in play. It's not accurate to a T with Australia, but I think it's very legible, and I think it's a very, very good thing to have a look at in terms of the market. So definitely consider that as well. Let's just give everyone a little bit of an insight as well to, also what is happening with wealth inequality. So this is just total growth, and this is actual income disparity in the growth of it. So you'll see just in the 50s and 60s there, most of the growth, actually, to be fair, was happening with the bottom 90%, and it's basically flipped on its heel. So now it's 93% has happened in the previous decade in the top 10%. Now, that's only income this is showing. So this is from the Australian Institute. If you look at that now and you make that wealth, it is a lot worse than that. I can tell you that right now. This is substantially worse, and it's getting worse and worse and worse. And the reason for that is, again, is because of the inlier numbers and inflation rates that the government completely lies to you about. And because of that, it's only the very rich and the very top end of people that can buy things. And the further and further it gets, the more and more the wealthier and wealthier squeeze the next income level or next percentile out. So that's what happens. So what I'm saying here is this is set to continue because of how things are being done. And that is going to continue. I kid you not, it is set to continue 100%. So what else is kind of going on with assets? So what I want to say is money goes into hard assets like land and business. Those are the first two I want to mention. So here's an example of house prices, and this is showing you just a kind of like coefficient, should I say ratio, and this is compared to income in the developed world. So this is not only including Australia, this is including Belgium, Canada, Switzerland, Germany, Denmark, and a lot of other Western countries, a lot of OECD countries of the world. Now, Australia particularly is probably, along with, I'd say, New Zealand, one of the worst in the world. So we've got a long way to go, really, in this, I should say. But this is kind of what's happening. So it's not immune to only Australia. Australia is one of the worst, for sure, if not the worst. You can see just house prices to per capita income in Australia, what is happening. So this is set to continue. This is only going to get worse because we don't base our dollar on anything. That's the reason. It's not based on a single thing. And I've said money goes into hard assets like land, business, and the other thing it goes into is gold and commodities. So here's just a graph of what has happened since the dollar was taken off the gold standard in 71. Yes, Australia was taken off in the 30s, but the one that really changed it was when Nixon took it off, because the US dollar is the global currency, and it based basically money printing on nothing. So you'll see just here the dollar has lost, and I think this is as of 2024, 98.5% of its value, and that was when gold was the price it was. And gold is now like 3,800 or so US dollars. It's like 3,800, so it's gone up substantially since then. So it's over 99% to give you an idea. It's going to fall a lot more than this. So it can't fall more than 100 because 100 is the max it can fall. But it's going to get closer and closer to the 100% mark since it was taken off the gold standard as possible. So this is set to continue. It's not the best thing to tell people, but it's just true. And I hate to tell people that, but it's just the truth. So that is kind of what's happening really here. It's not the best thing to tell people, but it is just the truth. And that is set to continue because it's not based on anything real. It's not based on gold. It's not based on the resources of the country. It's not based on the productivity of the country in the OECD. It's based on nothing. So they just print more and more and more of it. It inflates the currency, and it all goes into hard assets. It goes into land, which is real estate. Farmland you can include in that. It goes into land. It goes into businesses that are fundamentally, necessities. And it goes into precious metals / commodities. That's what it goes into. So this is set to continue, not the best thing to hear, but it's just the truth. This is the behavioural nature of our financial markets and housing markets at the moment.